Let me read you one of the top financial headlines over the last couple of days. This is from Yahoo Finance. President Trump gets closer to naming his pick to replace Powell as Fed's chair. Remember, Jerome Powell is the chairman of the Federal Reserve Bank, and the Federal Reserve Bank is the central bank here in the United States. And although they're called the Federal Reserve Bank, they're actually not federal. It's not a part of the federal government. Why does that matter? Because President Donald Trump and Jerome Powell have been butting heads. Jerome Powell has been saying, we don't want to cut interest rates because the Federal Reserve Bank has the ability to monitor our monetary supply, meaning they have the ability to cut interest rates, raise interest rates, and they have the ability to print money. And the Fed is saying, we don't want to cut interest rates. Donald Trump is saying, I want you to cut interest rates yesterday. Why does Donald Trump want to see lower interest rates? Because he wants to see lower mortgage rates, lower car loan rates, lower treasury rates, lower business loan rates to stimulate spending, stimulate the economy. Why does Jerome Powell not want to cut interest rates? Because he's concerned about inflation, he's concerned about tariffs, and he's concerned about the impacts of this on the economy. Now, President Donald Trump says that he wants to get rid of Jerome Powell, but he cannot directly fire him, at least not very easily, because the Fed is not federal. And this is where now those threats are starting to become a little bit more serious because Jerome Powell's term is expiring on May 2026. And now President Trump is talking about who could potentially replace Jerome Powell. And why is he talking about this so early? Well, let me read you why, according to Yahoo Finance. Because it is a way to undercut Powell's authority for the remainder of his term, which ends in May 2026, meaning if President Donald Trump announces who would be the replacement for Jerome Powell, he might not have as much ability to hold strong on not cutting interest rates. Maybe the rest of the people in the Federal Reserve Bank will be able to have more influence by the president to potentially cut interest rates. Maybe that has something to do with it. But if Jerome Powell is replaced and we start to see a new agenda for the Federal Reserve Bank to cut interest rates, this will change our economy. This will change the stock market. This will change a lot of things in, well, money. And that's something you want to pay attention to, which is what I want to talk about in this video. Now, if I sound a little bit stuffy, I apologize. I caught a cold over the weekend. I am getting better now, but that's why. Now, President Donald Trump has had some very strong words about Jerome Powell. He's called him dumb, he's called him incompetent, and a lot of other things. But the thing that the Federal Reserve Bank does, again, is they are monitoring the economy, and their job is to influence interest rates and to print money. Now, generally, the way that it works for the Federal Reserve Bank is when you are in a time of economic boom, the Federal Reserve Bank is generally trying to contain that boom so the economy doesn't overheat, so you don't see too much inflation. And during those super strong economic periods, you see the Federal Reserve Bank generally raise interest rates to cool down the economy. That's what we saw happen between 2022 and 2024, where the Federal Reserve Bank was raising interest rates to help fight the inflation problem. Well, they also do the opposite. When you are in times of a recession, of slow spending, of a slowdown in the economy, that's when the Federal Reserve Bank will generally cut interest rates and print money to stimulate the economy. Why? Because when interest rates fall, more people are likely to borrow money because it's cheaper. That means more people are buying houses, buying cars, buying businesses. And when that spending happens, well, that stimulates the economy, stimulates more job growth, it stimulates growth in the broader economy. And that's what we saw happen between 2020 when the pandemic hit and 2022. Well, now here we are in 2025, and there's a lot of confusion as to where we are in the economy. Some people say that the economy is booming like never before. Other people say that the economy is in a recession. And when you have these two types of polarities, you can start to see where it is difficult to decide what you want to do in the economy, and you have to pick a side. Do you want to be on the side of raising interest rates, cutting interest rates, or I guess in this instance, keeping interest rates the same? Now, we have been covering all of this in Market Briefs. Again, Market Briefs is my free financial newsletter for investors where every day my team is working to break down what's happening in the economy, housing, stocks, crypto, and global markets into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that are reading market briefs every morning. And when you join market briefs, you'll also get my investing masterclass as a bonus, which will walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. So if you want to join market briefs and get my investing masterclass all for free, all you have to do is click the link down in the description below. Now, if we do see a change in the Federal Reserve Bank, whether Jerome Powell changes his opinions or there is a new chairman who is much more pro cutting interest rates, what would that do for the economy? Well, remember, the interest rate that the Federal Reserve Bank changes is called the federal funds rate. This is not your mortgage rate. This is the interest rate that banks charge each other when they lend each other money. So you can think of it kind of like the wholesale rate of borrowing money. Banks will borrow money from one another, and then they're going to sell it to you. They're going to lend it out to you with a mortgage or a car loan or a credit card or a business line of credit. So when this federal funds rate goes down, the bank is effectively paying less money to get that money. So their cost of that money goes down, and then they lend it to you. So if their cost of that money goes down, they can effectively charge you less money when you go to borrow that money, which means if we see the Federal Reserve Bank cut interest rates, mortgage rates could go down, car loan rates could go down, business loan rates could go down, treasury rates could go down. And that means that people, in theory, would be able to borrow more dollars. But what does that mean? Well, let's look at this in the housing market because that's sometimes the easiest to understand. If mortgage rates were to fall, hypothetically, to 4% tomorrow, what would happen? Well, a lot of people who are sitting on the sidelines today would probably say, maybe this is a good time to finally get up and go buy a house. Now you might see more buyers entering the housing market. And when you see more buyers entering the housing market, that could potentially create more bidding wars. Now, at what mortgage rate would we see more bidding wars? Is it 4%, 5%, 3%? We don't know the answer. But what we do know is if you keep lowering mortgage rates, more buyers are going to enter the market. And more buyers mean that more housing transactions would be happening. Well, if more housing transactions would be happening, that could, number one, push home prices up, which is good if you're a seller, but it's also good if you're a realtor. It's also good if you're a mortgage banker. Now let's think through this. If realtors and mortgage bankers now start to see more business because more people are buying houses, that means these realtors and mortgage bankers have more money to buy a BMW. They have more money to buy nicer houses. They have more money to shop at Chipotle and buy the extra guac, and they have more money to go to Gucci. That means now that those businesses start to benefit as well. That's why lower interest rates can stimulate the economy. That's why you generally see lower interest rates during times of recession as a way to help the economy get out of the recession. But there's a risk because when you cut interest rates, well, you can create inflation. We've seen this happen before. I mean, in 2020, the Federal Reserve Bank cut interest rates to zero and they printed a ton of money, which was the cause of the inflation problem. When you inject a lot of money into the economy without having the wealth to support it, well, then the value of each individual dollar goes down, causing the prices of things to go up. So yes, if you lower interest rates, you could see more inflation, but there's one more part that you want to think about. Right now, the data says that our economy is strong. Unemployment is still relatively low. Well, if we were to enter a recession, how would we stimulate ourselves out of that recession then? Because let's think about this. I mean, we will see another recession. How do I know that? Because if we take a look at history, recessions happen. We've seen 16 recessions over the last century. They are a part of our economic system. So I can guarantee that a recession is coming. I don't know when, but we know that a recession will happen again. When that recession happens again, we'll want to stimulate our economy. And how do you stimulate? Well, you stimulate by cutting interest rates. Well, if we're cutting interest rates now, when the economy is supposedly very strong, what would happen if we go into a recession and there's not much margin to cut interest rates? What would we do then? Maybe that means we have to print more money. Maybe that means we have to go into negative interest rate territory, kind of like what Japan did in the past. Even Sweden has talked about going into negative interest rates. What would that do to the economy? And that's not super well understood. That could have different problems and implications. That's the risk with cutting interest rates when you are in a strong economy. Not to mention that if you're sitting on cash, well, when you have cash in a high-yield savings account, you can get some interest on that money. If you have cash in a treasury, well, the higher the interest rates are, the more interest you're going to get on that money. If you're sitting on cash, higher interest rates mean you can get better deals on assets. Lower interest rates mean, well, you're not going to get those same returns in a high yield savings account or a treasury, and, well, asset prices are generally going up when you have lower interest rates. So if you don't have a lot of cash, well, asset prices generally benefit from inflation, and asset prices generally benefit from lower interest rates. So if you don't have cash, well, you could be becoming poorer because you'll see asset prices keep rising while you are not having the ability to buy those assets. So there's a pro and a con with everything. And yes, low interest rates can make it easier for you to buy a house or buy a car, but generally, when you see lower interest rates, that can also make the wealth inequality problem larger. Higher interest rates, yes, are painful, but they also mean that people take on less debt. And for the average person, that's not a bad thing. The average person is using debt to make their banker richer, not to make themselves richer. And our economic system runs on spending. Not just spending the money in your bank account, but also spending debt. So yes, higher interest rates slow down the economy because people spend less money, but it's not because they have less money in the bank, it's because they can qualify for less debt. And you want to understand the dual-sided nature to this. Higher interest rates can keep the economy healthier and stronger, but there's a cost to it. The economic slowdown, the economic pain. A lot of people don't want to go through that. Lower interest rates can cause a boom, but you can also have more inflation, and they can also lead to more wealth inequality because if asset prices keep rising, that's good for the asset owners, but not so good for the people that don't have the money to buy those assets. This is why you need to have that financial education. That way you understand how you can win no matter what's happening in the economy. And again, if you want additional help, you can check out Market Briefs and my Investing Masterclass. I have the link for you down in the description. And I'll be working to keep you posted here on my YouTube channel. And I'll be feeling better very soon. That way you don't have to hear the nasally Jaspreet talk about this.